On a day when silver collapsed faster than at any moment in modern history, when prices didn't fall, they disappeared. When trillions were erased, accounts were liquidated, and panic spread across global markets. One trader was not panicking. He was not reacting. He was waiting. While the world watched silver fall off a cliff, and while analysts called it statistically impossible, this man walked away with $144 million in profit from the other side of the trade. But this is not a story about luck. And it is not a story about brilliance. It is a story about who really controls price, who sees collapse before it happens, and why what followed may signal something far more dangerous than a market crash. Because what happened after silver collapsed, in Shanghai, in Dubai, in the physical market, changes everything. And if someone understands that, they will understand why this story is not over yet. Welcome to Boring Currency Reports. If someone has lived long enough to remember when markets were simpler, when prices actually meant something, then they already know why subscribing today matters more than ever. So take a moment, subscribe, and stay informed the way serious people always have. And before we begin, tell us in the comments, where in the world are you watching from? On January 30th, 2026, the global silver market experienced something it had not seen in more than 4 decades. In a single trading session, silver collapsed from around $121 per ounce to nearly $70. More than $50 vanished in hours. This was not a slow decline. It was not a correction spread over weeks. It was a sudden break, sharp and violent, that caught almost everyone off guard. For analysts, the numbers were difficult to accept. Some described the move as a 6 sigma event, something that should not happen in a normal market. Others compared it to the silver collapse of 1980. But even then, the fall unfolded over time. This time, the market did not unwind. It snapped. Within 48 hours, more than $7 trillion was erased across global financial markets. Silver was not alone. Gold fell. Equity markets sold off. Risk assets across the system came under pressure. But silver stood out. It did not simply fall more than gold. It collapsed at nearly 3 times the speed. That imbalance mattered. Retail traders were hit first. Many had entered silver late in the rally, often using leverage. When prices began to fall, margin calls arrived immediately. Positions were liquidated without warning. Accounts were wiped out in real time. For some, years of gains disappeared in a single afternoon. At the same time, bullion dealers across the world were reporting something that did not make sense. In Dubai, Switzerland, and parts of Asia, physical silver was not flooding the market as prices collapsed. Shelves were empty, inventory was unavailable, there was nothing to sell, even as screens showed silver crashing. The disconnect appeared instantly. Most mainstream coverage focused on a simple explanation. On the same day as the crash, a new nominee for U.S. Federal Reserve Chair was announced. Markets interpreted this as higher interest rates for longer. The dollar strengthened, precious metals fell. The story was clean and convenient. But it did not explain the scale of the move. It did not explain why silver collapsed far more than gold. It did not explain why physical silver could not be found. And it did not explain why, in the middle of global panic, one participant emerged as a major winner. While traders watched losses mount, one position moved in the opposite direction. On the other side of the collapse, a single trader held one of the largest short positions in silver ever recorded. As prices fell, that position became extraordinarily profitable. Later reports estimated that after accounting for earlier losses, the net gain reached roughly $144 million. This trader did not speak publicly. He did not explain his strategy. His name was not widely known, yet his position was large enough to raise serious questions about how such exposure could exist at all. For business leaders and serious investors, this was the real warning. The story was not about one person making money. Markets always have winners and losers. The deeper issue was what this event revealed about structure. It exposed how leverage had built quietly beneath rising prices. It showed how quickly liquidity could vanish, and it highlighted how disconnected paper markets had become from the physical markets they were meant to represent. Silver had risen more than 4 times in less than a year. That kind of move attracts speculation. It pulls in leverage. By January, positioning data showed traders heavily committed in the same direction. The market was crowded. When a crowded market breaks, it does not decline slowly. Forced selling feeds on itself. Margin calls trigger liquidations. Liquidations push prices lower. In that environment, price no longer reflects value. It reflects urgency. January 30th was not just a bad day for silver, it was a stress test. It revealed how modern markets behave under pressure. It showed that confidence can disappear faster than supply can appear. And it raised a question that would define everything that followed. How did one trader see the break coming? And what does that reveal about the true condition of the silver market itself? Large market moves rarely happen without large players. In most cases, they are not visible at first. They do not announce themselves, they do not rush, they build positions quietly, often over months, sometimes over years. By the time the market notices, the damage is already done. This is how professional capital operates, and the silver collapse of January 30th followed this exact pattern. At the center of the event was a trader operating far from public attention. He was not a hedge fund celebrity. He was not a Wall Street executive. He did not appear on business television or speak at investment conferences. Yet his position in the silver market was so large that it stood out even among institutional players. He controlled tens of thousands of futures contracts, representing hundreds of tons of silver in paper form. In commodity markets, size changes everything. A small trader reacts to price. A large trader anticipates behavior. They do not need to be right about fundamentals in the short term. They need to be right about positioning. They study where leverage is building, where risk is concentrated, and where forced selling is likely to occur. This trader appeared to understand that dynamic better than most. In the months leading up to the crash, silver had become one of the most crowded trades in the market. Prices were rising quickly. Media coverage was positive. Analysts were raising targets. Retail participation surged. Leverage increased quietly through futures, options, and exchange-traded products. On the surface, everything looked strong. Underneath, pressure was building. The trader began building his short exposure during this period. This was not done in a single day. Data later showed that positions were added gradually, sometimes reduced, then rebuilt again. This suggests patience, not impulse. Early attempts were not immediately profitable. In fact, some early shorts lost money as silver continued to rise. Many traders would have exited at that point. He did not. This is an important distinction. Professional traders accept losses as part of positioning. They do not assume timing will be perfect. What matters is structure. By late January, the structure was clear. Silver had gone parabolic, leverage was extreme, any shock could trigger a chain reaction. 2 days before the crash, the trader increased his short position sharply. On the very day silver reached its peak in certain Asian markets, more contracts were added. This was not coincidence, it was a signal. He was not betting on news, he was betting on fragility. When the sell-off began, the position moved into profit almost immediately. As prices fell, forced liquidation amplified the move. Each dollar down increased pressure on long positions. Each margin call pushed more selling into the market. This is where scale matters. A large short position benefits directly from panic, not because it causes it, but because it is positioned for it. Importantly, there is no evidence that this trader controlled the market or manipulated prices directly. Markets do not need villains to fail. They only need imbalance. His role was not to push the first domino, but to stand where the dominoes would fall. This distinction matters for business leaders and investors. The risk is not one trader. The risk is the environment that allows such positioning to become profitable on such a scale. When markets reward those who bet against stability, it signals deeper stress. Another critical detail is where this trading took place. Much of the position was built through Asian exchanges rather than Western ones. This highlights a broader shift in global market influence. Price discovery is no longer dominated by a single region. Capital flows are global, and stress in one market can trigger consequences elsewhere almost instantly. While Western traders were focused on interest rates and central bank policy, positioning in Asia reflected a different concern: leverage saturation. This gap in focus is part of why the move caught so many by surprise. The warning signs were there, but they were not being watched closely enough. The trader's identity became public only after the fact, through reporting and exchange data. By then, the trade was largely complete. The profit had already been realized. The market had already broken. Attention arrived late, as it often does. For younger entrepreneurs and business professionals, the lesson here is not about copying trades. It is about understanding asymmetry. Markets do not move because everyone agrees. They move because pressure builds quietly and releases suddenly. Those who study structure, not headlines, tend to survive these moments. Those who follow narratives often do not. This trader did not predict the future. He observed the present more clearly than others. He saw leverage where others saw confidence. He saw vulnerability where others saw momentum. And when the system reached its limit, he was already positioned. The silver crash was not the result of genius. It was the result of preparation meeting imbalance. And that raises a deeper question that cannot be ignored. If one trader could profit this much from a single breakdown, how fragile is the system that allowed it to happen at all? Market crashes are often explained with simple stories: a policy decision, a political announcement, a shift in interest rates. These explanations are comforting because they suggest clarity and control. But the silver collapse did not begin with a headline. It began with mechanics. Invisible systems that function smoothly in calm conditions can become destructive when pressure builds. January 30th was a clear example of this failure. In the weeks before the crash, leverage across the silver market had reached unusually high levels. Futures contracts, options, and exchange-traded products allowed traders to control large amounts of silver with relatively little capital. As prices rose, this leverage appeared safe. Profits increased. Risk felt distant. But leverage does not disappear when markets rise. It accumulates. Exchange-traded funds played a key role in this buildup. Large inflows pushed managers to increase exposure using futures and derivatives. These instruments are designed for liquidity, not stability. When prices fall sharply, they do not absorb shocks. They transmit them. On January 30th, this transmission became a cascade. As silver began to fall, risk models triggered automatic rebalancing. Positions were reduced, not because managers wanted to sell, but because they were required to. This selling added to downward pressure. Lower prices triggered more selling. What started as a decline became acceleration. At the same time, futures exchanges increased margin requirements. This decision is often framed as prudent risk management. In reality, timing matters. Raising margins during a sell-off forces traders to add cash or exit positions immediately. Many cannot do either. Their positions are liquidated by force. This adds supply into a falling market. This process is mechanical. It does not consider value, fundamentals, or long-term demand. It responds only to price and volatility. On January 30th, the system responded exactly as designed. It amplified stress. This explains why silver fell faster than gold. Gold markets were less leveraged at that moment. Silver, being more volatile and more heavily used by speculative traders, carried greater exposure. When the unwind began, silver had more pressure to release. The result was asymmetry. The same macro shock produced very different outcomes. Liquidity also disappeared at the worst possible time. In normal conditions, buyers step in when prices fall. During forced liquidation, buyers wait. They know more selling is coming. Bid-ask spreads widen. Prices gap lower. This creates the illusion of free fall. In reality, it is the absence of liquidity, not the presence of panic selling, that drives extreme moves. High-frequency trading systems added another layer of complexity. These systems react to momentum and volatility. When prices move quickly, algorithms reduce exposure or flip direction. This increases volume but reduces stability. The market becomes faster, not deeper. What is important to understand is that none of this requires malicious intent. No single decision caused the collapse. It was the interaction of rules, incentives, and timing. Each component behaved logically on its own. Together, they produced a breakdown. This is why the silver crash matters beyond commodities. The same structures exist across modern markets. Leverage, automated risk management, and interconnected products are everywhere. They create efficiency in calm periods and fragility in stressed ones. When confidence breaks, the unwind can be sudden and severe. For business leaders, this raises a serious concern. Many strategic decisions rely on market prices as signals, but during events like this, prices stop reflecting reality. They reflect mechanics. If capital allocation decisions are made during these periods, they can be dangerously misinformed. The silver market did not collapse because demand disappeared overnight. It collapsed because positions became unsustainable. The price move was a symptom, not the cause. Understanding this difference is critical. The most revealing aspect of the crash was what happened next. As paper prices fell, something unusual occurred. The physical market did not respond as expected. Supply did not rush in. Inventory did not appear. Instead, availability tightened. This divergence was not immediately visible on trading screens. It showed up in delivery delays, rising lease rates, and regional price differences. These signals were ignored by many because they did not fit the dominant narrative. But they pointed to a deeper issue. If the paper market could collapse under its own weight while the physical market remained tight, then the pricing mechanism itself was under strain. This is not a theoretical problem. It affects how risk is measured, how contracts are priced, and how trust is maintained. January 30th was not simply a volatile day. It was a demonstration of how modern market infrastructure behaves under stress. The lesson is not that volatility is dangerous. The lesson is that complexity without resilience can turn stress into collapse. And this brings the story to its most uncomfortable question yet. If paper mechanisms can overwhelm price so completely, what happens when the physical market refuses to follow? In a functioning global market, the same commodity should trade at nearly the same price everywhere. Small differences are normal. Transport costs, taxes, and timing create minor gaps. But large gaps do not last. Arbitrage closes them. That is how price discovery is supposed to work. After the silver crash, that system failed. As futures prices in New York collapsed, the physical market did not respond in the way theory predicted. Instead of metal rushing out of vaults to meet lower prices, physical silver became harder to find. Dealers did not cut prices. Many stopped quoting altogether. In several regions, silver could not be purchased at any price. In Asia, the divergence was impossible to ignore. While Western futures were trading near $80 per ounce, physical silver in parts of Asia was priced far higher. In Japan, buyers paid well above $100. In Shanghai, prices remained elevated. In the Middle East, premiums widened sharply. The same ounce of silver was being valued very differently depending on location. This was not a short-lived anomaly. The gap persisted for days, then weeks. Under normal conditions, traders would buy silver where it was cheap and sell it where it was expensive. That did not happen. The arbitrage channel was blocked. One reason was cost. Lease rates for silver spiked rapidly. Borrowing metal became expensive. When financing, insurance, and transport were added, the potential profit disappeared. What looked like a clear opportunity on paper was uneconomic in reality. Without arbitrage, the gap remained open. Another reason was trust. Many participants did not trust paper claims to deliver physical metal on time. In periods of stress, delivery matters more than price. Buyers were willing to pay more to secure immediate supply rather than risk delays or cash settlement. Price became secondary to certainty. Inventory data supported this view. Exchange warehouses reported falling stock levels. Metal was leaving storage, not entering it. This was not speculative hoarding. It was consumption and withdrawal. Once removed, that metal was not easily replaced. The paper market, meanwhile, continued to trade enormous volumes. Contracts representing hundreds of millions of ounces changed hands in a single session. These trades did not require physical delivery. They required only margin. The scale was disconnected from physical reality. This created a situation where two markets existed at the same time. One was liquid, fast, and highly leveraged. The other was slow, constrained, and increasingly scarce. Both claimed to represent the price of silver. Only one involved actual metal. For business leaders, this distinction is critical. Many industrial users rely on futures prices to plan costs and secure supply. If futures prices no longer reflect availability, planning becomes risky. Contracts may be cheap on screen, but impossible to fulfill in practice. The divergence also exposed how dependent global pricing is on confidence. Futures markets function because participants believe contracts can be honored. When that belief weakens, behavior changes, premiums rise, inventory is withheld, supply tightens further. This is not unique to silver. Similar patterns have appeared in energy, shipping, and agricultural markets during periods of stress. But silver's dual role as an industrial input and financial asset makes it especially sensitive. When confidence in paper pricing weakens, physical demand does not disappear. It intensifies. Another important signal was backwardation. Near-term delivery became more expensive than future delivery. This is a sign of immediate scarcity. It suggests that buyers are willing to pay extra to secure metal now rather than later. This condition is rare in precious metals and usually temporary. In this case, it persisted. What made this more concerning was timing. The divergence occurred after a major price collapse. In theory, lower prices should ease demand pressure. Instead, they increased it. Buyers viewed the drop as an opportunity, not a warning. This behavior suggests that the crash did not change the underlying supply-demand balance. It changed who was forced to sell. Paper holders exited. Physical buyers stepped in. The market rotated rather than resolved. For entrepreneurs and executives, the lesson is uncomfortable but clear. Prices can fall without conditions improving. Volatility can hide stress rather than release it. Relying on market signals without understanding structure can lead to costly errors. The silver market was sending two messages at once. One said price was falling. The other said metal was scarce. Both were true within their own systems. The problem was that those systems were no longer aligned. When a market reaches this point, it is not correcting. It is fragmenting. And fragmentation introduces a new kind of risk, one that cannot be hedged easily. This sets the stage for the next part of the story, because when markets fragment, power shifts away from traders and toward those who control supply, when supply becomes a strategic weapon. As the silver market fractured, a different group of participants moved quietly in the background. They were not reacting to daily price swings. They were not trading volatility. They were securing supply. For them, silver was not a chart. It was an input, a reserve, and increasingly a strategic asset. Governments were among the first to act. In early 2026, Chinese authorities reclassified silver as a strategic resource. This decision did not make headlines in global media, but its implications were significant. Once a commodity is labeled strategic, it is no longer treated as a normal export. Controls tighten. Permissions are limited. The goal shifts from market efficiency to national interest. Export licenses were reduced. Fewer companies were allowed to ship refined silver abroad. This effectively placed a ceiling on how much metal could leave the country. For global markets, this mattered deeply. China is not only a major consumer of silver, it is also one of the world's most important refiners. Restricting refined output reshapes global supply flows. At the same time, industrial buyers adjusted their behavior. Large technology and manufacturing firms began bypassing exchanges altogether. Instead of buying futures or exchange-traded products, they negotiated directly with producers. These agreements locked in future output before it ever reached the open market. This shift is telling. And when sophisticated buyers lose confidence in market pricing or delivery, they do not complain. They adapt. Direct supply agreements remove uncertainty. They are more expensive up front, but they reduce risk. For companies that depend on silver for production, certainty is worth the cost. These buyers were not speculating on price. They were managing operational risk. Silver is used in electronics, energy systems, medical equipment, and advanced manufacturing. Substitutes are limited. Delays or shortages can disrupt entire supply chains. From that perspective, price volatility is a secondary concern. The mining side of the market added another layer of constraint. Silver production is slow to respond to price. Most silver is produced as a byproduct of mining for other metals. Even a sharp rise in silver prices does not immediately increase supply. New projects take years to develop, permit, and build. This means that when demand rises or supply tightens, the system cannot adjust quickly. Inventories act as a buffer, but those inventories were already declining. Once they are drawn down, there is no rapid replacement. For decision makers, this creates a structural problem. Short-term price signals suggest abundance. Long-term supply dynamics suggest scarcity. Planning based on one without the other is dangerous. Another important change was behavior at the state level beyond China. Some regional governments began reviewing their exposure to precious metals. Vaulting arrangements, storage decisions, and reserve policies came under scrutiny. These actions do not happen in stable environments. They reflect concern about access and control. All of this occurred while paper markets continued to trade as if nothing fundamental had changed. Futures volumes remained high. Price volatility was extreme, but contracts were still settled. To many observers, this suggested normalcy. In reality, it masked divergence. The key insight here is that strategic actors operate on different timelines. Traders think in days or weeks, businesses think in quarters, governments think in years. When these timelines diverge, markets become unstable. The silver crash forced a separation. Short-term traders were removed through liquidation. Long-term holders increased their commitment. The market did not clear. It polarized. This polarization is not easily reversed. Once supply chains are secured privately, metal stops circulating freely. Liquidity declines. Price discovery becomes less reliable. Volatility increases. For young entrepreneurs and business leaders, this matters far beyond silver. It illustrates how markets behave when inputs become strategic. Energy, semiconductors, and critical minerals have shown similar patterns. Financial instruments lag behind physical reality. The silver market was no longer just about price. It was about control. Who had access? Who could wait? Who could not? And this leads to the final question that must be addressed. If supply is being locked away while paper prices remain unstable, what does that mean for the future of the market and for those who still rely on it for signals? The warning: hidden inside the collapse. By the time the silver market stabilized, the most important damage had already been done. Prices had partially recovered. Volatility had slowed. Headlines moved on. To many observers, the crisis appeared to be over. But for those paying closer attention, the real signal came after the crash, not during it. What January 30th revealed was not just weakness in silver pricing. It revealed weakness in how modern markets communicate truth. Prices moved violently, yet they failed to answer the most important question. Was silver abundant or scarce? Depending on which market one observed, the answer was completely different. This contradiction is not academic. It has real consequences. Businesses rely on prices to plan production, manage costs, and allocate capital. Investors rely on prices to assess risk. Governments rely on prices to understand supply security. When prices no longer reflect physical reality, decision-making becomes distorted. The silver market showed how this distortion forms. Paper markets, driven by leverage and automation, reacted to stress by forcing liquidation. Physical markets, driven by availability and necessity, reacted by tightening supply. Both reactions were logical within their own systems. The problem was that the systems were no longer aligned. For serious decision makers, this creates a dangerous environment. Risk appears reduced when prices fall. In reality, risk may be increasing. Volatility shakes out weaker participants, but it does not create new supply. In fact, it often concentrates ownership among those with longer time horizons and stronger balance sheets. This is why the identity of the successful short seller, while interesting, is ultimately secondary. The trader did not create the conditions, he exploited them. The real story is that the market structure allowed such an outcome. That structure still exists. Leverage remains embedded across global markets. Automated risk controls are still widely used. Physical supply chains remain tight. None of the underlying constraints that contributed to the crash were resolved by the price decline. They were merely hidden. There's a broader lesson here for entrepreneurs and executives. Markets are increasingly shaped by financial engineering rather than physical fundamentals, especially in the short term. This creates opportunities for those who understand structure, but it creates risk for those who rely on surface signals. Silver serves as a case study, but it is not unique. Similar dynamics are visible in energy markets, shipping, and critical technology inputs. In each case, paper instruments trade freely while physical access becomes more controlled. Price becomes a poor substitute for availability. This environment rewards patience and preparation. Those who can secure supply early gain stability. Those who depend on just-in-time pricing take on hidden risk. This applies to manufacturers, infrastructure planners, and even financial institutions. The crash also exposed a timing problem. Markets tend to react after stress becomes visible. Strategic actors move before, governments restrict exports quietly, corporations sign long-term contracts away from exchanges. By the time these actions show up in data, the opportunity to respond has passed. For younger business leaders, this suggests a shift in thinking. The question is no longer just, what is the price? But can the asset be delivered when needed? And who controls access during stress? These questions are harder to answer, but they matter more. The silver market did not fail because of speculation alone. It failed because too many participants assumed liquidity would always be there. When liquidity vanished, leverage turned from advantage to liability. This pattern repeats throughout financial history. What makes this episode different is speed. Modern systems unwind faster than human judgment. Decisions are executed automatically. Feedback loops compress time. When limits are reached, adjustment is immediate and severe. This leaves little room for reaction. By the time risk is visible, it is already priced in or mispriced. Those who survive are those who planned before the event, not those who reacted during it. The final warning is simple but uncomfortable. Markets can function normally right up until they do not. Stability can mask fragility, and when pricing systems fragment, they do not heal quickly. Silver's collapse was not the end of a story. It was a signal that paper and physical markets are drifting apart, a signal that leverage remains a dominant force, and a signal that those who control real assets operate under a different set of rules. For those willing to listen, the message is clear. In the next period of stress, whether in metals, energy, or another critical input, the same pattern may repeat. Prices may move violently, narratives will follow, but the real outcome will be decided quietly by those who secured access before the system was tested. The silver market offered a preview. The question is not whether it will happen again. The question is who will be prepared when it does.